Are you falling for the same car buying traps most people do? The average new car costs around $48,000, and almost 1 in 5 buyers are signing up for $1,000 plus monthly payments, which is crazy. But if you follow these smart rules, you'll never get stuck in that trap. Most people walk into a dealership and get hit with two things: pressure and numbers that sound better than they really are. Dealers push for 6 or 7 year loans, stretch out the payments, and try to convince you that you can handle $500 a month or more, you can afford the car. But that's not how it works. You need to look at the total cost, not just the monthly number. I almost fell into this myself. A couple years ago, I was eyeing a shiny Mercedes. It looked good, it felt great, and I told myself I deserved it, but then I did the math. That $30,000 could have turned into over $60,000 if I just left it in the S&P 500 index for the same amount of time that I would have the car. That was my wake-up call. Cars take money out of your pocket, investments put money in. The first rule is the 25-4-10 formula. This rule is the base of smart car buying because it keeps your budget safe and stops a car from eating all your money. 25% of your yearly income is the most you should spend on a car. For example, if you make $60,000 a year, your max car price is $15,000. That leaves you money for rent, food, savings, and investing. 4 years is the longest loan you should take. A shorter loan might mean a bigger monthly payment, but it saves you from paying thousands extra in interest. You also own your car faster instead of owing the bank for 6 or 7 years. 10% of your monthly income is the most you should spend on everything car related: the payment, the insurance, and basic upkeep. So if you bring home $4,000 a month, you should keep your total car costs under $400. That way, you still have 90% of your paycheck for everything else in life. Here's a simple side-by-side example. Imagine two people both make $60,000 a year. Person A buys a $40,000 car with a 6-year loan. Person B follows the 25-4-10 formula and buys a $15,000 used car with a 4-year loan. Person A's payment and insurance together are about $800 a month, almost 25% of their take-home pay. Person B's costs are closer to $350 a month, under 10% of their income. The first person is stretched thin every month, while the second person has an extra $450 left. Now here's the key part that matters. If a surprise $1,200 car repair or medical bill hits, person A has to swipe a credit card and go into debt. Person B has a $450 cushion every month, so in just 3 months, they've built up enough to cover that same $1,200 emergency without stress. That extra margin is the difference between staying safe and falling behind. This formula isn't about saying no to nice things forever. It's about making sure you don't get trapped by a dealer's sales pitch that only shows you the monthly numbers. Following this formula is the smart way to buy because it keeps you safe from overspending and gives you freedom to build real wealth instead of paying for a car that keeps losing value. Rule number 2, understand depreciation and interest. Cars lose value fast. On average, a new car drops around 20% in value during the first year and close to 50% by year 5. Some cars lose even faster. EVs can lose close to 59% in 5 years, while trucks and hybrids are closer to about 40%. Think of it like buying a new phone that loses half its value the second you open the box. That's what happens with cars, only with a much bigger price tag. And if you finance that car for 6 or 7 years, you're paying thousands extra in interest just to afford the monthly payment. For example, a $25,000 car at 7% interest over 4 years costs about $28,700 total. Stretch that same loan to 6 years and now you're paying about $30,700. That's almost $2,000 gone just for stretching out the loan. It's like paying for 2 pizzas just because you wanted smaller slices. That doesn't even count maintenance, which is also rough. For example, a BMW X5 usually costs well over $20,000 more to own over 5 years compared to a Toyota 4Runner once you factor in repairs, insurance, and fuel. That's money that could have been invested, saved, or spent on experiences instead of repairs. The key idea here is that long loans and expensive cars eat away at your money quietly. Think of depreciation and interest as leaks in a bucket. slowly draining your money faster than you realize. Rule number 3, protect your wallet with insurance. Even if you follow these rules, there's one more thing that can save you money when buying a car, and that is your car insurance. Your credit score, your driving habits, and whether you bundle policies can change your rate by hundreds of dollars a year. Some companies give discounts for safe driver apps, bundling auto with renters or homeowners insurance, which can save you 10 to 25%. So don't just pick the first insurance company that pops up. Compare rates like you'd compare car prices. I'll leave the tool that I use to compare auto insurance quotes in the description as well. Use free tools like Edmunds or Kelley Blue Book to understand the value of the car you're looking at, and then line that up with insurance quotes to see the true cost. For example, Progressive Insurance has a snapshot program where they lower your bill just for signing up. Think of it like a coupon applied right away just for joining. Then as the app tracks your driving, you can earn bigger savings if you prove to be a safe driver. This means if you avoid hard braking, speeding, and late night driving. And the app can save you up to about 30%. For example, if your normal insurance is $150 a month, Snapshot can bring it closer to $105. Allstate has a DriveWise program that gives you a sign-up discount right away, usually around 10%. Then if you drive safely, you can earn up to 40% off at renewal. Imagine you were paying $180 a month. A full 40% saved driver reward could lower that to $108, putting an extra $72 a month straight into your pocket. Lemonade is another option. They give you discounts if you drive fewer miles, have a hybrid or EV, or if you bundle with their renters or home insurance. For example, bundling car and renter's insurance could cut 10 to 15% off both policies at once. Each company has its own perks, but don't get lost in the details. Progressive's Snapshot, Allstate's DriveWise, and Lemonade's bundle discounts are easy to understand and can save you real money. I'll go deeper on which company is the best in my next video on the best car insurance companies. For now, just know it only takes a few minutes to check your rates, and you could save hundreds of dollars per year. I'll leave my favorite tool to compare quotes in the description below. So let's recap the smart rules for buying a car in 2026. Rule number 1 is the 25-4-10 formula. It matters because it keeps your car budget safe and gives you breathing room every month. Rule number 2 is understanding depreciation and interest. It matters because cars lose value fast and long loans drain your wallet without you even noticing. Rule number 3 is protecting your wallet with insurance. It matters because the right company and discounts can save you hundreds every year. Stick to these rules, and that's how you buy a car the smart way. And if you found this helpful, check out my other video where I break down the best car insurance companies that you can use to save even more money right now.